If you're a real estate professional, I would really encourage you to pay attention to the analysis that the banks are putting out. This is actually the biggest drop that we've ever seen in house prices in Canada. Most markets, including the Canadian average, are tighter than average. I do think that we're pretty clearly in a recession. Prices down in Vancouver, Victoria, Ottawa, and the GTA. Everywhere else, prices have risen. If there's like a bull case for Canadian real estate, I would argue that it's likely that home ownership is becoming extinct. But first-time buyers actually seem to be back with a vengeance in the Canadian market. It's the largest share that it's been of the total ever. 41% of individual buyers of condos are under the age of 30. Huge increase in rental and apartment buildings. Huge decrease in detached. Basically, detached is the lowest it's been, and it's kind of stuck there. Thanks a lot, everyone, for joining. This is our August 2025 edition of the monthly market call between Real Estate Magazine and Valerie. I'm going to start off just by talking a little bit about house prices. Obviously, house prices have been grinding down, slow and steady. We've been talking about this for a while, how, historically, if you go back to like the 1990s, and I put a couple of charts in last month's call about it, you saw a big drop at the beginning, at the onset as interest rates started going up. And then historically, as affordability starts to improve, you will see more transactions, but prices still need to come down. Interest rates have already done their job. Wage growth has kind of done a little bit of its job in creating more affordability. But most of the gains from affordability come from improvements in house prices. And we're going to talk a little bit about that today, and who really seems to be the buyer group that's benefiting the most from the improvements in affordability. If you look at the changes in the house price index, other than the kind of like little quick rebound market that we saw coming out of the interest rate hiking cycle, when we saw the pause and a little bit of optimism in that first spring market, that was kind of the only time where we saw year over year increases in price. And then basically since then, we've been either at zero or below zero. And right now we're at about negative 3.4% on a year over year basis. And this analysis comes from RBC. One of the things you'll note that I've added for this report is I put a lot of bank logos in the top right-hand corner of like where I've pulled analysis from the banks. If you're a real estate professional, I would really encourage you to pay attention to the analysis that the banks are putting out. Simply because like the big theme for me right now, and I'll talk about it when I talk about which buyers are actually executing in today's market, but the banks are the ones who really determine whether or not transactions get done. Everybody thinks it's the buyers or the sellers or the appraiser or the home inspector, but it's really the banks, right? We're in a credit-driven market. So we're in a market where basically people need debt to buy houses. And one of the hallmarks of a recession is you start to see something called credit contraction, which means that banks are reluctant to lend money. They only really lend money to excellent borrowers. And what that gives us is a market where deals are harder to get done, and really select and qualified buyers are the ones who end up transacting. And this is becoming visible in the data, and we'll go through that. Now, to contextualize the drop that we've seen in house prices, this is actually the biggest drop that we've ever seen in house prices in Canada, at least on record. This chart here comes from the Federal Reserve in the US, who unironically has better house price index data on Canada than we do. But you can see kind of past corrections. You saw 22% drop over an 8-year period in the 1970s, 21% drop over a 9-year period in the 1990s. So that was like kind of your last major housing correction, the one that I try and draw the most comparisons to. And then 2008, we saw kind of a sharp drop of about minus 10%. You also saw one in 2017, not really noted on the national average here as much, but 2017 we saw B20 stress test. We saw the non-resident speculation tax in Ontario. We saw the foreign buyer ban or foreign buyer tax in BC in 2016, and a little bit of a rate hiking cycle during Trump 1.0. There were consequences to house prices that were visible during that period of time, but not massive enough to really be worth measuring on this chart. And in present day, we're down about 23, almost 24% off peak. Um, and this matters from my perspective because I mentioned that house prices are really going to be the driving factor of restoring affordability. As prices come down, people buy more houses, right? Any good is like this. If prices come down and the good is more affordable to more people will buy that product. And this is really what we're starting to see in Canada right now when it comes to house prices. Um, just a little quick, what I'm going to run through today. I'm going to talk a lot about first-time buyers. I'm going to talk a lot about the job market, housing starts, especially in the kind of the disparity that we're seeing between the rest of the country and Ontario. I'm going to talk about a little bit about inflation data, the US Fed, what we can expect from the Bank of Canada by the end of the year, and sort of outlooks towards a recession that we might have. I'll skip the about me just in the interest of getting right to it. Um, so at a national level, we're in a balanced market. Um, we're in a balanced market that slightly favors sellers. So you'll see on the top chart here, this is national sales to new listings ratio. But then if you go to it on a city by city basis, which BMO has broken down below, um, you basically can see that some markets, and it tends to be the more affordable markets really trend in favor of sellers. The less affordable markets tend to trend in favor of buyers. And this is because Canada is a credit-driven market. If people can't take on more debt to buy or pay more money for houses, then the price of those houses is going to go down. And so markets like Vancouver, so I drew a line here at the 50%, but you have the red line below that shows sort of your buyer's market. Balanced is between 40 to 60% sales to new listings ratio. And then the green line is your seller's market. So you'll notice that markets that are in a seller's market territory, you've got places like Edmonton, Regina, Winnipeg, Montreal, Quebec, and most of the East Coast. And in a buyer's market territory, this is kind of below the black line, would be where you're trending in favor of buyers, but still in a balanced market. You've got places like London, Hamilton, Guelph. And then in your buyer's market territory, you've got markets like Barrie. Toronto's getting there. It was there last month. It seems to kind of eased off a little bit. Summer is tough. I'm always reluctant to use like July and August data to make determinations about a market, just because they're, as anyone who's practitioner in the market would know, they're not super high volume, so they're not typically exceptionally reliable data points. Same thing, I probably wouldn't use a December as a um, data point that I would use to really decide on a direction or trend in the market. Um, if you look at this more on an active listings to sales ratio, and then National Bank put out this chart basically showing how far it's deviated from its average or standard deviations from the mean. So are we above or below the average? Most markets, including the Canadian average, are tighter than average. So most markets are more in favor of sellers, except for your really unaffordable markets, Ontario and BC. And Ontario is significantly looser than average. So that means market with more supply, more leaning more towards excess supply. BC would be in the same situation. If you want to kind of get an understanding for this sort of like directionally, you can just sort of look at the house prices across a couple of different markets. So we've got here, you can see Vancouver, Calgary, Edmonton, Toronto, Ottawa, and Montreal. And I've sort of applied some kind of like headings to each of these. So Vancouver is a market that I would call grinding down. Toronto as well. You've seen a steep drop in prices. And now we're kind of like, so you saw your big drop where you saw prices come down almost like 10% year over year. And now we're sort of in the slower, 2 to 3% drop environment, sustained over a period of time. Calgary is a market that I would call that has kind of rolled over. So it's come over that high growth and is now dropped below zero. So Calgary is actually now down about 1.8% on a year over year basis. And I'm going to go through which markets are winning and losing on a price growth basis across the country as well. Edmonton is a market that I would say is rolling over. So you can see that Edmonton sort of had this really big run up in price, and then it's starting to trend now down towards that 0% line. And the expectation would be Edmonton's a little tough because it is a really affordable market, but it does have a ton of supply. And we'll talk about that. I'm going to go through a rental supply scenario, which I think is really important for people to look at. But if you look at markets like Ottawa saw the big drop. It did grind down a little bit, but it seems to be kind of stable above that 0% mark. And I would call that sort of in a slow recovery. The asterisk that I have for the slow recovery for Ottawa is that Ottawa is very vulnerable to government layoffs. The federal government is saying they're going to eliminate something like 60,000 jobs. I think 30,000 of those would be in the Ottawa market. And so I would say that there's obviously a headwind or risk factor ahead for a market like Ottawa. Montreal is a market that I would say is firmly in recovery. And the big reason for this is it's the most affordable metropolitan market in Canada. Calgary has actually surpassed it. That might change now as prices are coming down or rolling over in Calgary. But if people want to live in a city and they want to be able to afford to live in that city for both rents and ownership, they might go to a market like Montreal where there are a lot of jobs and they can have a much lower cost of living or at least a cost of housing in that market. On a monthly basis, looking at the same thing that National Bank, the way they analyze sort of deviation from the mean, you can see Ontario. So we've heard that home sales are up in Canada, and they are up. But again, I try not to use July and August data points. Not super reliable. I do think home sales will be up heading into the last quarter of the year. I think the reason for that is people are buying houses because prices are coming down. And so you're up from July of last year in the number of homes sold in Ontario, New Brunswick, Saskatchewan, BC, the Canadian average, and Alberta. Nova Scotia is up a little bit. But July was a really low base, right? July of last year was like one of the worst sales months of the year, or sorry, of history. And so to be up 1, 2, 5, even 10% from that it's obviously an improvement, but you're comparing to something that was not good to begin with. And so I wouldn't say that this is super optimistic for the real estate space. It's optimistic that it's going in the right direction, but it's not like all of a sudden all of our problems are solved because we're doing 50 or 100% more deals than we were, or we're doing the same number of sales that we were doing, during the pandemic. We're not really in an exceptionally good sales environment. There's a lot of transactions that are not happening, and this is kind of, I don't know, it's just a slow market, right? And the real estate market really will only improve, and it'll improve gradually as prices continue to come down or affordability starts to improve. And that can happen in one of three ways. Rates can come down, which we'll talk about. And it's probably I would expect we'll see another 25, 50 basis points towards the end of the year. Even though the inflation scenario isn't exceptional, I do think that we're pretty clearly in a recession, and recession tends to get a lot of those metrics that the central banks are looking for back to the neutral range where they're comfortable to cut. And also in the US, the Federal Reserve's discussing cutting. In spite of high inflation, they have a dual mandate. So they'll probably cite jobs as the main reason why they want to see interest rates come down to kind of return some growth to the employment market. On top of what's happening on the resale market, we've obviously seen a huge decline in pre-construction home sales. This chart comes from the Globe and Mail, but basically new condo sales are down 86% off peak in Toronto. This is as a percentage of the annual average. So off peak is probably even more than that. But as a percentage of average, we're down about 86%. Kitchener-Waterloo, similar to Ontario. Most Ontario markets, Hamilton, Ottawa, are all similar. And we're going to talk about why this is happening and sort of put some of the consequences of it. Even your markets like Edmonton, Vancouver, and Calgary are down pretty substantially by comparison to what their average sales are. The other thing is, and this graph comes from Desjardins, is that completed and unabsorbed apartment units remain well above the average. So we're also seeing a lot of excess supply in the market that needs to be absorbed. The other piece here is, so we're hearing a lot about like excess supply. where basically, as people are talking as if the resale market needs or has too much supply, and that's creating a problem for, for house prices. It'll continue putting downward pressure on house prices. I would say that historically, we just broke through the average active listings in Canada. So this is basically back to 1989. Again, the last time we saw that major housing correction. This is your average properties for sale active listings for sale in Canada. And you can see, like, again, we literally just broke through that long-term average. An important thing to note here is even though we're below or above average, this is not adjusted for population. So if you think about the fact that our population, you go back to 2008, basically blowout of the global financial crisis to the pre-pandemic era, that was a market where we had above average listings. That was a normal market, right? People were transacting, people were able to make money. The real estate profession was doing fine. We're just above that now, and we have population is probably 10% higher than it was during that period of time. And so I always think that relative supply is also an important consideration. So active inventory for July is still below average. So this chart here shows basically the same as above, except it kind of just removes all the cycles. So you can see all those those peaks and valleys are kind of just your seasonal cycles. Active inventory is still below average for the month of July. And so our supply from a July perspective is actually not exceptionally high. Do I think this could change? Yeah, I probably do think that we'll see, as we head into a recession, as we head into job losses, layoffs, et cetera, we'll probably see more distressed supply and fewer buyers. That would mean that we're probably trending toward an increasing supply environment, but we're still not there yet. I mentioned I would get back to Calgary on the house price declines. Calgary recently joined Vancouver and Toronto as one of the three markets that have seen a year-over-year decline in house prices. So Greater Vancouver is down about 2.5%. Toronto's down over 5%, and Calgary is now down about 1.8%. Every other major metro in Canada is up from a house price perspective on a year-over-year basis, with some markets like Quebec performing exceptionally well. And I'll get to kind of growth in certain markets, not just on a 1 year, but on a 5-year basis. If you move that out to a 3-year period, so I just went through kind of what happened in the last year, but if you move that out to a 3-year period, Calgary is doing fine. And then you really just get to your unaffordable markets, so BC and Ontario, where house prices are actually down on a 3-year basis. So you've got prices down in Vancouver, Victoria, Ottawa, and the GTA. Everywhere else, prices have risen in the last 3 years. An important piece to note here is that rents are falling as well. And this is another way that housing affordability can come down, especially when you think about its role in CPI or the inflation, right? CPI is the way that we measure inflation in Canada. And you have rent inflation in there, and then you have mortgage costs. And those are two of the biggest components of inflation, which we'll talk about when I get to inflation a little bit. But if you take the basket, the only big red flags that CPI has right now are rent inflation and the mortgage renewal. And so we know that both of those are coming down. Mortgage renewal component of CPI will come down as we get to the other side of the renewal wall. And rent inflation will come down. We know that rents have been falling for basically, well, actually, you can see it here on the next chart and the RBC chart on the right-hand side here. Rents are falling basically in half of Canada's larger cities. And if you look at asking rents by select CMA, basically rents are falling in almost every city except for Montreal, where they're basically flat, but they're low there, right? So that'll also skew CPI down. This is important because once we get to the point where that decline in rents actually is realized in CPI or in the consumer price index, then CPI inflation will actually come down. Now, the Bank of Canada doesn't really look at CPI, especially the one that includes shelter. So it doesn't matter a ton, but CPI will likely end up trending down and below the neutral range, just as a lot of those costs get stripped out. There is risk, obviously. I mentioned this pretty exhaustively in last month's report, but there's risk that you start seeing a lot of tariff push-throughs, where basically a lot of the tariffs on U.S. goods that end up being purchased in the U.S. for distribution and then distributed into Canada. Those tariffs get pushed through to the Canadian consumer. Also, we had counter tariffs. It seems like we've actually walked those back, which is optimistic for the inflation scenario in Canada. But counter tariffs would also be absorbed by the Canadian consumer. Those would both be inflationary. So that's a bit of a risk, but I still don't think that it's as substantial of a risk as how much shelter inflation will actually bring CPI down. Again, the Bank of Canada uses core CPI, which is excludes gasoline and shelter because those are so volatile. And so it's not really going to change their decision making, but it will change likely what consumers actually feel if their mortgage costs aren't going up or if their rents are coming down. Not that people who are renting units will see their rents fall, because in most cases, landlords aren't that nice to capitalize it in. But if people are shopping around and maybe they rented a place for $2,500 2 or 3 years ago, and then they go and they can rent the same unit for $2,000 or whatever, they could realize that deflation in rents. The one thing that I'll say here in regards to rents is that the reason that rents are falling, and from my perspective will continue to fall, is because we're actually about to see record a record increase in supply in rents. And I'm going to go through a couple of charts that show us this. I also did a YouTube video on it. If you scan the QR code on the screen right now, you can just go watch that if you want a more exhaustive look. I also interviewed the economist who did the report. And obviously don't have him on the call today. So if you want kind of straight from the horse's mouth to hear his analysis on what's happening, I would encourage you to check that video out. Basically, the chart at the bottom here shows rental market construction and then rental market share of the total construction market in Canada, not just residential construction, but all construction. And it's now nearly 50% of all construction in Canada is coming from rental activity. So production of basically rental units. And CMHC's rental market construction is now basically the highest number that it's ever been. And it's almost the highest that it's ever been on a per capita basis, which I'll show you in a second. And so we have basically record rental completions coming onto the market. This is obviously going to have sustained downward pressure on rents and sustained upward pressure on vacancy rates. And so for investors or tenants who are looking, for some relief, I would say that this is something that you want to consider. Investors obviously want to be modeling in that rents aren't going to be growing. A lot of people who are doing a lot of these, CMHC, MLI Select pre-con deals, who are doing buy and hold rentals, pre-con condos that are, we have record pre-con condo closings right now. You really want to be paying attention to what's happening with rents and not modeling in that they're going to grow 5% year over year because they did last year, because that's not the case, right? We've seen that rents are falling. We know why, and we know that it's probably going to continue because there's more of that why coming, which is more rental supply. CMHC observed the same thing here. They have a chart that came out that shows Canada rental apartment completions from 1970, which was like the last era, kind of before we really shifted our policy environment to home ownership in Canada, where we really started building that obsession with home ownership, that it was a core tenet of the Canadian dream. We built a lot of rental, and then we really just shifted, basically set 80s, 90s. We went from basically building no rental housing for 2 decades before present day. So basically from the last housing correction to now, and then sort of 2017, you really started to see a ramp up. And then as that CMHC MLI Select product was introduced to the market, rental construction has basically skyrocketed since then. And just to really observe like how much of a role CMHC has in this, 80% of those rentals actually come from CMHC MLI Select. It's actually 88% come from CMHC programs of all types. I put this in last month's report, this chart, but about 80% come from MLI Select itself. 88% come from a combination of MLI Market, which is basically you don't get the extended amortization. It's just kind of conventional CMHC financing. You get a cheaper rate, but normal amortization, normal leverage point. So where MLI Select is, you can get a higher leverage point, so lower down payment. And you can get up to a 55-year AM. And then they also have something called ACLP, which is Apartment Construction Loan Program. That one's really more used by like bigger developers. A lot of people claim that there's like cronyism in that space. It's really kind of like reserved for the biggest and best because that's actually direct money that CMHC is lending. It's not insured loans. So the question here becomes which cities are most at risk for this oversupply? And Central One broke it down really good in the report that I just mentioned. And I would encourage you to watch that video that I did with Brian Yu. But basically, you can see here the ratio of units under construction to the rental market supply universe. So they basically took the number of units under construction and divided it by the number of units that it currently exist in that market, rental units that exist in that market. And this is the number. And so you can see the scale goes as high as 30. I'll just zoom out a little bit so you can kind of see the entire list. But basically, Kelowna is building about 30% of their current rental supply. The easiest way to think about this, and I've talked about this in the last couple of market calls, but this is the first time I've really seen somebody present the data so well on a city by city basis, is if Kelowna doesn't see any population growth, which I don't have any reason to believe that that would be the case, but if it doesn't see any population growth from interprovincial migration or new household formation, so people moving out of their parents' house and being a couple or getting a place on their own, then Kelowna's vacancy rate would jump up like 30% if there's not more tenants consuming these units. Barrie is the Ontario market that's the highest with over 20% of their current rental supply under construction. And then you've got Vancouver, much of the East Coast, and markets like Calgary. The interesting part is, you have to go all the way down the list to get to a market like Toronto, where you've got like about 5% of your rental market under construction right now. And you go like even further down, you get markets like Sudbury, Peterborough, and St. Catharines, where they're not building a huge amount relative to what their existing supply is. And the biggest reason why Ontario isn't able to deliver as much of this is Ontario is the hardest place to qualify for these CMHC MLI Select loans. One of the big reasons for that is the way that CMHC underwrites what they call affordable housing is it's basically local incomes relative to the rents. And so I think it's 30% of median household income, which is what they would consider affordable, right? CMHC's criteria for affordable or attainable housing is that you're only spending 30% of your income on housing. And so they want to try and enforce that the average market participant would only be spending 30%. And in Toronto, our incomes are really low relative to our rents. And so a developer isn't going to go and build a bunch of affordable units because they can go get way higher rents using either the condo format, which is obviously not doing well, or not using the affordability criteria. And so Ontario, in order to qualify for CMHC MLI Select, it does seem to work in markets like Ottawa, and you can see Ottawa is actually quite a bit higher up. I think it's the highest Ontario city after Barrie. Ottawa has a lot because their local incomes are high relative to rents. Toronto just doesn't have that. Vancouver, they have a similar issue to Toronto, but their cost structure is different because purpose-built rentals actually have a lower development charge than condo format. And I think that it seems like we might be heading in that direction for the city of Toronto, where they have a new development charge kind of update coming up in September, October, I think. And there's speculation that they'll actually be waiving or creating some sort of deferral for rental rather than condo. So all the governments are trying to incentivize more and more rental construction. And it seems to be working, right? CMHC is playing a big role in this as well. I will say that I'm not really like somebody who's trying to find the silver lining in a lot of things, as I'm sure most of you noticed. But if there's like a bull case for Canadian real estate, I would argue that it's likely that home ownership is becoming extinct. And so you go to markets like Switzerland or Germany or whatever in Europe where the home ownership rate is way lower compared to Canada. As that home ownership rate comes down, home ownership becomes more and more of a scarce thing. Single family detached becomes super scarce. Toronto will be losing single family detached. Vancouver will be losing single family detached because people will be tearing them down and replacing them with multiplexes. And so the scarcity that drives single family detached values up, not immediately, but in the long term, will probably be the bull case, the only remaining bull case for single family detached housing as we trend more and more towards a European housing model. Um, so just another way of looking at this is rental units under construction just in their entirety. And you can see most of these markets are basically like hockey stick graphs. But some markets just already have a lot of supply, and so they don't show up in the previous graph. But basically, you've got, your um, markets like Barrie, again, a hockey stick graph. Calgary, same thing. Most markets in Canada are basically seeing a huge increase in rental supply. The only ones that really stand out to me as kind of low are the ones that it never really made sense to do this type of construction. Like Sudbury would be an example where not a lot of people are building rental up there. There's the other way of looking at this is sort of relative supply. So this is that kind of relative to their existing supply, and this is where you can see again Kelowna and Barrie. But the rest of them, the rest of the cities really aren't seeing a massive increase. Like again, you've got Vancouver and Victoria here, Saskatoon, Moncton, a lot of the East Coast cities, but like you go to a city like Toronto, and it's really nominal by comparison to existing rental supply in a city like Toronto.
Dan, we just had
Yeah.
a question here. Someone just wanted to clarify. So your bull case is that the value of single family detached will increase over time because it will become more scarce?
Yeah, I mean, eventually, yes. I think that like that's the long-term bull case for single family detached is that we're not building any more of it. I'll put a couple of charts out about that as well, but we're not building it anymore. It's all being replaced with rental. And so home ownership is basically becoming extinct, and it'll become more scarce, more coveted, and more of a luxury product or a luxury good, which sort of detaches it from the broader economy. Um, Again, I think that before we get there, you've got 2 or 3 years worth of rental and condo supply that needs to be absorbed. So I think that short term we are in for some headwinds. I think even before you get to once you get past that, you've got the other headwind, which is a lot of baby boomers are selling this single family detached supply as they downsize or decease out of their existing McMansions. And it seems like policymakers are trying to put a floor on that by actually making these multiplex projects more and more zonable and viable. Now you've added an output value that should increase demand for those types of projects. But you've got basically you've got the two biggest cohorts of Canada's population, your baby boomers and your millennials. And your baby boomers are going to move properties from as they either again downsize or decease, basically. They will move that supply over to the millennials. And most millennials, if that requires a transaction, most millennials can't afford it. And so like your marginal buyer can't afford the 4 bedroom McMansion that a lot of baby boomers are holding and therefore selling. So there's very little exit liquidity. So I would say that's hump number two that we need to get over. And then you're kind of back in a long-term growth scenario for Canadian housing. Depending on how much of that unaffordable supply, again, your 4 bedroom McMansions goes from baby boomers to millennials through inheritance rather than transaction, that could expedite it. But I don't know. We don't know what that's going to look like. You'd have to see everybody's will, right? Um, I'll skip over this one just in the interest of time, but going back to prices, New Brunswick is actually the market that has seen the leading price growth on a 5-year timeline. So you've got New Brunswick, Quebec City, and Nova Scotia as the three leading markets of price growth in the last 5 years. So basically from before the pandemic or kind of like early pandemic to present day. Another thing that National Bank observed that I found interesting was the number of cancellations. I've been looking at this for Toronto, and basically we just saw 3 months of record cancellations in the city of Toronto. And I think that this is potentially a bit of a pent-up supply scenario heading into the fall market where you basically got your like a lot of people terminate listings to relist them, right? And so I would say you've probably got some sellers that are potentially giving up, but you've also got sellers who will be probably relisting in September, October, maybe even in the spring, right? So the fact that we've got a lot of terminations sitting here is a lot of people who thought about selling, wanted to sell. Again, what portion of them actually just gave up and decided not to transact is really going to determine the outcome of whether or not we end up in an oversupplied market for the next 6 months or an undersupplied market for the next 6 months, from my perspective.
Dan, I'm just going to pop in with a question, which I'm
Mhm.
excited for because it's about my city. This person asks, what are your thoughts on the St. John's market?
Um, yeah, it's a good question. I think that St. John's is a really small market, and so it would really only take a handful of projects to like move the needle from an undersupplied to oversupplied market right now. But it does seem really constricted right now. Um, we've seen a lot of house price growth year over year in all of Newfoundland, and I would say that the what seems to be the driving force for that is you're actually seeing some baby boomers, well, baby boomers and young people, but moving to that market in search of affordability for like retirement. Like I think St. John's is a great market. If I'm a baby boomer who retired from a Ontario or like another city, I want a more small city environment, but I want all of my amenities, and I'm gonna be snowbird in Florida for whatever 4 or 5 months of the year, for the months of the year that suck in a market like St. John's, um, I would be looking at a market like St. John's. And so I think that's a big driving force is that I think that people underestimate how many, I think everybody thinks about baby boomers as like this really wealthy cohort. I think people underestimate how many of them are kind of below the average. Like, if you take your average wealth, statistically or median wealth, half of the people are below that. I think it is a good market for all of the people who are below that line. So I think that's piece number one. Piece number two is it has oil market exposure, which oil is ripping right now. It's the same reason why we're seeing a lot of growth in Calgary. Not the only reason, obviously. And then I also think it's just like it's one of those affordable markets, especially even in the East Coast when you think about your Torontonian, right? A Torontonian went to a market like Calgary or Halifax, and then those markets got unaffordable. And so the Calgarians went to Edmonton, or the people from Halifax went to Moncton. And so that's where you kind of get your second order effects. And then your unaffordable people, or the people who are priced out of markets like Edmonton or Moncton, can go to, you'll often see people kind of just like move within Atlantic Canada, right? So, because it is all pretty close, with Newfoundland being the exception, it's pretty far away. But I think that that's the other piece. So I think that there's a handful of things. So what are my thoughts on it generally? I think that uh, historically we've seen any market that really grows like crazy in Canada tends to come down in the same fashion, um, with the exception of like Calgary, which I do think it's starting to roll over. But even like Moncton saw a big spike. It came down, jumped up like 15%, came down 10. So your net gain is 5. Halifax, similar thing, kind of up 15, up 20, maybe down 10, 15. I would say St. John's will probably give some of that growth back, but I don't think that it's going to be as severe as a market like Ontario or whatever, where it's purely credit driven. Um, it's still an affordable market even at current prices, and Calgary is behaving kind of the same way as this. So as long as that stays true, as long as there's wage growth there, there's job growth there, then it could still have some stability, but I think it'll give back a little bit of the price gains. Hope that answers your question. Um, Okay, I'm going to jump. I mentioned I was going to talk about first-time buyers. First-time buyers, this is just an Ontario data set from Terranet, so our land registry system in Ontario. But first-time buyers actually seem to be back with a vengeance in the Canadian market. They are now, for the first time ever, other than like a very, very brief period at the beginning of COVID. And I think that's actually an important thing to think about. First-time buyers are now dominating the non-condo property ownership transfers for the last 2 years, and now 33% of all purchases in 2025. To me, this is really important because the question was always like, who's coming back into the market? Like, why are buyers re-entering the market? There's so much risk. And when you think about like multi-property owners or people who are moving, or investors, they're not feeling that sense of urgency, based on what's happening. Any losses in the market would also be reflected in the house they're going to sell. We're obviously in a risk environment for investors with rents declining, et cetera. But first time buyers, like for them, it's like, okay, I know that I have a 25-year amortization on this mortgage. I'm going to be paying this mortgage for 25 years. Only the next 5 years of it really matters, in the current rate environment. So I'm locking in a fixed or even a variable. Not that only the next 5 years matters, but only the next 5 years is really like vulnerable to the rate environment that I can see sitting in front of me right now. And most people don't really think about rates this way, but like that's how the rate environment works. You don't really know what rates are going to look like from year 5 to 25. So first time buyers are coming back in the market because prices are coming down and they're saying, okay, I don't know how much worse it can get, but I told myself that I didn't want to buy when prices, were $1 million a foot or $1 million in Toronto, but now or whatever, they're 1.4, but now they're 1.1. And it feels like a market that I can enter. So there's that. They're buying a little bit more new builds. And the other piece is that we saw, obviously, the CMHC cutoff just went up. So there's a lot of policy changes that are trying to make the market more favorable for first-time buyers. And this is important because first-time buyers generally, if you look at like all buyers in the market, not just transacting, but at a national level, first-time buyers are 50% of your market, according to the Bank of Canada. Um, Investors are still the ones taking the condo market in the city of Toronto or in Ontario. And the reason for this is likely because your investors are closing on a record number of units this year. We have like something like 50,000 closings this year, 25,000 next year. And so all of those pre-con units that were committed to before are showing up in that investor data. Um, but first-time buyers are increasing their exposure to condos. And one of the interesting parts is that you're actually seeing single-income first-time buyers entering the condo market, which makes sense to me because a lot of those condo units that were brought to the market by builders recently are just not suitable for couples, like your hotel room sized condos. And so you're seeing more and more individual first-time buyers. Um, your high earning T4 super qualified buyers re-entering that individual condo market. But they are buying cheaper condos on average. If you look at their non-condo purchases, they've actually trended up to 762,000 in the last year. This is Ontario data. And then down for the condo to 588,000 in the last year. And so again, as prices fall, more people can afford that good, more people will buy that good. And first-time buyers are buying more new condos. As a share of total, the top component of this bar here, the lightest green, is first-time buyers buying brand new condos. It's the largest share that it's been of the total ever. If we look at how first-time home buyers are buying condos versus freehold, the markets where they really seem to be doing a lot, obviously Toronto is going to be really the hottest market for condos. You see a little bit in Mississauga and York region. And then on the freehold side, you see a lot of first-time buyers buying in Toronto, but Durham seems to be a massive one for first-time buyers buying freehold houses. And then markets like York region and Simcoe as well. And Ottawa is on there as well with similar growth to a market like Durham. So we are seeing a lot more first-time buyer activity in Ottawa and the kind of first and second ring suburbs of the GTA. So do you have another question? I think I saw one pop
Yeah,
up in the chat there. Yep.
got a couple questions here. This one's directly related to this conversation. It says, if many first-time buyers are purchasing condos, how does the resale market look for them, especially in Vancouver?
I mean, it's trending in a positive direction. I would say that it's probably like for most people, it really depends on what like I think your average first time buyer would be having the doing the math of like how much does it cost me to rent this unit versus how much does it cost me to own this unit, and for the most part, Vancouver rents are a lot higher than Toronto, I would say, and so that spread is tightening in a market like Vancouver. It still hasn't become more compelling for most people to like if we're just thinking purely how much am I going to spend per month. It still hasn't become incredibly compelling for people to uh, own rather than rent in a market like Vancouver or Toronto. But what a lot of people do is they'll deduct, and this is just mental math, like and maybe even mental gymnastics that a lot of people do. They'll deduct the principal payment, right? Because they say, oh, well, the principal payment is money that I'm saving. So if I'm renting, it's a sunk cost of $2,000 a month. Whereas if I'm owning, let's say it costs me $3,000 a month, but I'm paying $500 in principal and then I'm paying, whatever in condo fees. And so they think, okay, well, it's going to cost me $1,000 extra, but I get $500 back. This is kind of the way that I think a lot of people think about it. And Vancouver, that gap, that $1,000 gap that I just described, is tightening. Toronto, it's tightening as well, but rents are coming down a lot more severely in Toronto. Um, Vancouver rents came down quite a bit, but they've sort of stopped falling at the same clip as a city of like Toronto. Um, and so I think that the market is becoming more favorable as that spread tightens. I think that the market will get a lot better as that spread basically gets to almost nothing, which I could actually see happening. And that's really where you get to recovery, when it really just becomes economically sensible for the average owner who can save a 5% down payment to buy a property rather than rent it. I hope that answers the question. Um,
Just got one more
the
question
yeah,
there
yeah, go ahead.
before we dive back in. It says, with all of the banks and government mandating back to office over the next 6 months, how would this impact the Toronto rental and purchase market?
Yeah, so if for those of you who scanned the QR code on my for my YouTube channel, I just did a video on return to office. I think that it's obviously going to have an impact, but and so we have like, let's say 60,000, I think it's 60,000 people coming back to work. Could be even 100,000, right, in return to office. I think that the way to think about this is like the impact is obvious, right? There's obviously more people consuming downtown. And so how many of those people are going to want to move, go get maybe a pied a terre, like a little condo that they can live in 4 days of the week or whatever? How many can afford that? How many are going to rent it versus buy it? Um, how many are going to maybe move from the 705 to, maybe they got a cottage in Kawartha or Muskoka, and they're not going to drive 2 hours now. They have to come back to office 4 days a week. Are they going to go to a Barrie where they can still have that kind of like lifestyle that they wanted and take the GO train in for those days a week? So I think your first and second ring suburbs that have transit that can make that commute less painful will probably see some I don't want to say improvement, because I still think that there's like a more downward force on those markets, oversupply, layoff risk. People can't afford it, right? There's affordability, but they'll have some embedded stability. And I do think that this is probably a policy objective. It wouldn't surprise me, right? Like all of your banks have exposure to all the mortgages in the 416 and 905, all the condo projects in the 416 and 905. And these are the same banks mandating people back to the office. So do I think this is a little bit of a layer to try and create a bit of stability? Yes. Do I think that it'll outweigh the raw economic forces of uh, what's happening in Canada right now? Probably not, but it'll likely support it in recovery when we get there. 416, I think will feel it the most. You'll see like a lot of work people who have like geographic mobility. Maybe they're renting in the 905 right now, renting in the 705 right now, and they're just like, okay, I'll just move back downtown as rents are coming down. So that should eventually kind of floor your rents. Will it floor prices? I think again, it's a gradual thing, right? You think about people choosing to move downtown. It's gonna maybe they're everybody's mandated back to work like 4 days a week in October. Maybe by the time it's 5 days a week in February, they're all thinking, okay, I can't do this anymore. Now I'm going to buy. And so I think it's how long does it take for the average person? And I think a lot of people are going to test the waters before they make that decision, see how bad traffic is, see how bad the GO train commute is, see if there are cheaper options nearby so they don't have to change their lifestyle too much. And if they do, then if they have to make that change, then they're not going to do it immediately, right? They're going to do it over the next 6 to 12 months. Um, yeah. So I think it's a factor. I think it's one of many positive factors for house prices in the 416 and 905, but it's against many negative factors in the 416 and 905. I think it's anyone's guess, but I think that we've probably still got a bit of like another year of turbulence before these things all become net positive as a lot of that turbulence gets erased. Rates come down, job losses are done, employment's growing, wages are growing, house prices are down to a point where many more people can afford them. Um, in regards to the first time buyer bid, was there any other questions or no? Sorry, you're on mute.
It's everything.
Okay, cool. Yeah, so in regards to these first-time buyers, the thing I found interesting was your one-party condo buyers I would have assumed like your kind of first-time buyer bid especially for single condos, would be sort of like 30 to 35, but it actually seems like the overwhelming majority is actually 25 to 30. And then, or sorry, the largest group is 25 to 30, and then it goes to your 30, 35. So if you break this down, you look at young buyers um, as kind of like a pie chart. 41% of individual buyers of condos are under the age of 30, which is really interesting from my perspective for real estate professionals, a lot of whom, younger real estate professionals more likely to attract younger clients. This is why a lot of realtors focus on first-time home buyers because they're kind of people who have gone through the same thing as them. That market is basically like the biggest that it's ever been as a share of total. It's not, and I would caveat that like we're using this year's data, which is obviously a much smaller sample than historically, but it seems like that young people who really felt marginalized out of the market and were waiting for a certain moment to kind of start re-entering the market. We've heard a lot about like buyers on the sidelines. It does really seem like they are trickling back into the market. I won't say they're flooding back into the market because a lot of people just can't afford it, and I'll explain kind of what that whole thing looks like. But they are trickling back into the market. Um, I'm just going to jump through a couple of these other ones. Even on the non-condo side, 28.5% are between the age of 25 and 30, which again fascinated me. The interesting thing about single first-time home buyers and couples is that they're overwhelmingly using big six lenders. And historically they had, but like you had tight spreads where they were doing it less so. And you were seeing growth in kind of your Alt-A or like B lender space. But this is the highest number that we've ever seen for single people using big six lenders. And last year was the highest number that we've ever seen for couples using big six lenders. And the reason I would say that this is significant from my perspective is it really illustrates to me that we are in this like credit contraction where your Bs and your Alt-A space is becoming less and less competitive, or just less willing to lend. And so you're like your single kind of T4 buyers who again probably a little bit more financially sophisticated, obviously high earners, sort of your like AAA buyers. Those seem to be the people who can get debt and are sort of looking at the market and saying, this is something that I kind of want to dip my toes into and gradually start moving towards. Um, and so that's sort of why I kind of mentioned this earlier, but like that 2025 is very much becoming the year of the qualified buyer. One of the hallmarks of credit contraction is that people who can't, like people B or C borrowers just aren't getting money, right? Whereas you go back to COVID, like your B and C and D borrowers, like there's just cheap money flying everywhere, right? And all the bad deals and all the like, people overpaying, people, whatever it was, like that was very much a theme during that period of time. That's going away, and it's going away because lenders are the ones who are deciding the outcome of deals. And it's always been this way, by the way, but people just don't pay as much attention to it during a bull run. But now that we're in a bear market, it's clear that lenders are the ones calling the shots, right? And this is a very important theme to think about. If you're a real estate professional, one of the things that I would say, like, you should have a mortgage professional working your CRM with you, right? You should be pre-qualifying all of your leads, not just as like, oh, I don't want to waste my time with unqualified buyers, but as a service, because the best thing that you can do to help somebody get closer to buying a house is actually make sure that they have a mortgage. And this is one of the hardest things for people to get in today's market. It's the biggest headwind for people to make a transaction. Um, we are seeing a big uptick in mortgage activity. This was the second highest June on record for mortgage originations, which basically means like new mortgages. There's a sort of a reason for this. It's not because there's a ton of new transactions, as we've already discussed earlier in this call. Transactions are at a really low level, but there's a big piece coming from a lot of condo completions, which was observed by Better Dwelling. So a lot of your pre-con condo buyers, again, like there's 40 to 50,000 condos closing this year, so that's going to give it a big jump up. But then the other piece is that we're at the renewal wall, right? The renewal wall is actually here. And so every renewal that comes up can get shopped. It can become a new mortgage, or it goes back to that lender and that becomes a mortgage origination because it's a new 5-year term. And so we're finally sort of in the middle of that renewal wall. And this to me is like it's like the remaining big headwind. As we get to the other side of that renewal wall, 60% of mortgages are supposed to renew by the end of 2026. That's when you can actually think about a recovery taking place in Canadian real estate, but not until then, right? Everybody needs to reset at new rates, get into this new credit cycle. Historically, though, if you look like again, it's a big jump. So the chart that you see here is that kind of like the looks like a pretty steep jump. But if you look at that historically, we're well below sort of your historic pandemic level or even a normal market era of growth in mortgage debt, right? So we're not in a market where we're seeing a ton of growth in mortgage debt. Even though, if you look at sort of month over month or year over year trends, it looks like there's huge growth. We're not in like a really, really robust lending market. I'll skip through a couple of these. Basically, your loan to income rate is increasing, but debt service ratio or debt service ratio is decreasing, which means that basically rates are coming down. So people are paying less as relative to their income on their mortgages, even though the loan amounts relative to their income are increasing. People are flipping less houses. I think that's kind of it that I want to cover in regards to rates. This is an interesting one regarding an analysis from RBC, and I'll give you kind of another opportunity to get to my YouTube channel where if people want to check out that thing about return to office, that's on there. But then I also covered this RBC report, which I'm going to try and very quickly rip through because I realize that we're tight on time. But basically, the rest of Canada is building a ton of housing, and I showed that in kind of those rental charts, but Ontario is really, really falling behind. And so this is that scarcity where when people talk about like, or when somebody asks me about like single family housing becoming scarce, this is one of those big long-term risks for Ontario. Could that make single family housing more and more affordable later? Absolutely. The big reason why we're seeing a decrease in construction in Ontario is because construction costs have outpaced everywhere else. And because there's more resale supply available, so there's not a lot of excess demand. Like the big reason the whole condo thing happened, pre-con condo thing happened during COVID was there was so much excess demand. So many people wanted to buy. There was limited availability in the resale market, so it spilled over into the pre-con market. Now you have the opposite. There's so much available in the resale market, and so nobody's moving over to the pre-con market. And as a result, Toronto condo starts have plummeted pretty substantially. And you can see the yellow line here that tracks it pretty consistently is your pre-construction sales 1 year prior. So you would argue that this condo start line is going to continue trending down, basically. Ontario municipalities are still issuing a lot of building permits. They're just not getting filled. The Oh yeah, I guess you can to really contextualize this, you can see Canadian housing starts, huge increase in rental and apartment buildings, huge decrease in detached. Basically, detached is the lowest it's been and it's kind of stuck there. So we're not seeing a ton of detached construction. Um, just an interesting thing that a new survey from Nanos, more than half of Canadians believe that house prices need to fall to make the market better for future home buyers, which I thought was interesting. I'm going to try and very quickly wrap up on interest rates here. Basically, CPI is down, core CPI is not down. Core CPI is, as I mentioned, without gasoline or shelter CPI. And so the Bank of Canada tries to strip those out to remove some volatility. Core CPI is not where they want it to be, which is really not creating an exceptionally positive scenario for cuts in the near term. I still am of the opinion that we'll probably see 25, 50 basis points towards next year. And we'll certainly see probably another 50 plus by the end of next year. But the key thing from my perspective to watch is what's happening in the US because we have two forces now that are giving us this risk of imported inflation in Canada right now. Number one is the Canadian dollar gets weaker if we're ahead of the Fed. But number two is they're collecting tariffs and then passing those costs through to Canadian consumers as they export goods to Canada. Those are both imported inflations and not something that is within the scope of what the Bank of Canada can control, except if we want to keep the Canadian dollar, kind of in a safe spot relative to the USD. They don't want to get too high, and which is why they might cut to sort of protect export activity, especially because our exports are subject to tariffs in the US. But they don't want to cut too far to weaken the Canadian dollar so that we're importing inflation just via foreign exchange. Yeah, so I hope that covers everything. I'm just gonna stop my screen share here. Happy to do any questions if anybody has them.
We had a lot of people wondering if the recording will be sent out after. I messaged the chat to say that the recording will be available on both the Valerie and the REM YouTube pages.
Yeah.
But do you folks send these out in an email as well?
Uh, I don't, yeah, we can for anybody who registered. If we have an email list, we can just email it out, email the link out once it's up to everyone.
Okay, a lot of demand for the replay.
Nice.
We also had a piece of feedback. Can you make the charts a little larger?
Yeah, typically I do a proper screen share. I'm just traveling, so I just had to use the PDF format for this one. So next time, absolutely.
Okay. Yeah, no, I think that's it for questions. Just a lot of folks would like a recording.
Okay. Yeah, 100%. We can do that.
All right. Oh wait, here's a question. How do you use all of this data at your brokerage?
Yeah, so we typically we put all of this into our AI that advises clients. I guess advise is the wrong word, but information gathering is a big role of what realtors do. And then so we will do that plus like very, very local market information. We take that and we compile it so that our agents can actually like send very specific market reports to all of their individual clients. So I would say and we have a tool that very simply does that. They can literally speak into the agent assistant on their phone and say, hey, send so and so a market update for Burlington or whatever, right? So that's the way that I would say that we really try and use it, and that's like the big reason why I'm doing these things is we're just constantly feeding the AI as much information as it can possibly get, good information as it can possibly get, because that's what's important in helping clients make decisions.
Okay, and we just had one more question come in. It
Mhm.
says, "What are your thoughts about the CRA link to mortgage approval process? Is it coming or happening already?"
I think that they're going to belabor it as long as they can. It's not like it's a hard thing to do, right? So it will happen, but it'll probably happen when we're sort of back. I don't think they're going to do it right now because they're trying to keep as many components as they get to support the housing market as possible. But basically, and I think that it is one, right? People committing mortgage fraud is obviously bullish. They're willing to overpay. They have ulterior motives. Um, if like it's not hard to do, right? You can sign a form right now and get your accountant to go to log into your CRA and get a income verification form. Like it'll take them 5 minutes after you've signed the form. So and you can't tell me that banks don't have that ability, right? They have accountants on staff. They have accountants that they pay. So the idea that this is a very difficult infrastructure to create is kind of silly. And so what with that knowledge, what other reason would they have for not doing it ASAP? Probably because they don't want to, right? When will they want to? My perspective would be they'll want to when the market is stronger and this isn't going to completely kill their book of business and the market itself. They'll probably also want to do it as we're getting past OSFI. Like currently, OSFI's stress testing the stress test. So they're basically deciding whether or not if the banks have a 450% or 4.5x loan to income cap on their entire portfolio, if that'll have the same um, risk mitigation outcome as the stress test. So the banks are subject to a stress test rather than the borrowers. If that yields results, I think that the test goes from November of last year to November of this year, then the assumption is that OSFI will get rid of the stress test or at least loosen it a little bit. I would say that banks probably don't want to be doing a ton of things where they're cracking open the books and trying to get a lot more scrutiny on their borrowers when right now they're limited. So yeah, I'm of the perspective that it'll happen. I just don't think it's going to happen as soon as everyone wants it to happen. But it'll probably be part of the suite of like tools that the market will use to try and recover the market when we really need it. So, let the foreign buyer ban expire, let mortgage or try and cap mortgage fraud. That's like kind of a negative one. Let the foreign buyer ban expire. That's a positive one. Immigration will probably ramp back up. Credit will be a lot cheaper, et cetera. So I can't see them trying to deliver a hit to a market that's you don't want to beat someone while they're down, right? Yeah. So that's kind of my thought.
That looks like
Cool.
everything. Yeah.
Okay. Amazing.
Okay, well, thanks everybody for joining. And I guess we'll see you next month. And thank you so much, Daniel. Everyone
Amazing.
really enjoyed that. We got lots of positive feedbacks in the comments.
Thanks. Yeah, I really appreciate it. Thanks, everyone. Have a good long weekend, and let's get back to it in September.
Okay, take
Okay,
care.
bye.